You check your portfolio on a Saturday morning. 12 positions, 4 ETFs, 2 bonds, 3 individual stocks, a little crypto, a little real estate fund. You spent 6 months building this, reading, researching, balancing. The market is up 18% this year. Your portfolio is up 4.3%. You scroll through each position. Nothing is catastrophically wrong. Nothing blew up. Everything is just slightly wrong. The tech ETF underperformed. The bonds dragged. The international fund has been flat for 2 years. The crypto is down 22%, but it's only 5% of the portfolio, so it doesn't matter much. You diversified. You did what the smart money people told you to do. You spread the risk. And somehow, you managed to lose to the market while owning a piece of everything in it. That feeling has a name. It's called diversification. And nobody warns you about it before you spend 6 months building the portfolio that causes it. Before you close this, I know what you're thinking. You're thinking, this video is going to tell me to put everything in one stock. Concentration risk. What if it goes to 0? That's not what this is. Diversification is real. It does what it says it does. It reduces the risk that any single position destroys your portfolio. That is a legitimate and valuable thing. But there's a version of diversification that has nothing to do with risk management and everything to do with anxiety management. And those two things produce very different portfolios with very different results. This video is about the difference between the two and how to know which one you're actually doing. 3 things we're covering. First, what over-diversification actually costs in real numbers over real time periods. Second, the strongest argument for maximum diversification and the assumption inside it that most people never examine. Third, the specific situations where concentration is genuinely the right call. And at the end, a 3-question framework to figure out whether your current portfolio is built around a strategy or built around fear of being wrong. Meet Sarah. She's 31, product manager, makes $98,000 a year. Smart, careful, does her research. In 2020, Sarah builds a portfolio with $35,000. She puts it across 14 positions: U.S. Large Cap ETF, U.S. Small Cap ETF, International Developed Markets, Emerging Markets, REITs, Bonds, Gold. 3 individual stocks she believes in: a clean energy fund, a healthcare fund, and 4% in crypto because she doesn't want to miss it entirely. She feels good about this. It's balanced. No single position is more than 12% of the portfolio. She's protected. Over the next 3 years, the S&P 500 returns 31.4% total. Sarah's portfolio returns 11.2%. She didn't lose money, but she underperformed the simplest possible alternative, a single index fund, by 20.2 percentage points over 3 years. On $35,000, that's a difference of $7,070 in absolute returns. Not a catastrophic loss, just a quiet, invisible underperformance that accumulates year after year. Here's the number Sarah never calculated. If she continues with this approach for 25 years, and the performance gap persists at even half the rate, roughly 3% per year underperformance, the compounding cost on her initial $35,000 plus $500 monthly contributions is approximately $187,000. $187,000. Not from a bad investment, from too many mediocre ones. Here's what actually happened in Sarah's portfolio. The international fund dragged because dollar strength crushed foreign returns. The bond allocation reduced volatility, but also reduced returns in a rising rate environment. The clean energy fund had 2 great years and 1 terrible one, and ended roughly flat. The individual stocks she chose, 2 of 3 underperformed the index. Every position had a rational reason to be there. Together, they guaranteed average. And average, compounded over 25 years, is an expensive outcome. Here's the best argument for maximum diversification, and I want to give it to you honestly because it's the foundation of modern portfolio theory. The math is clear. Adding uncorrelated assets to a portfolio reduces volatility without proportionally reducing expected return. A portfolio of 20 stocks has dramatically less idiosyncratic risk than a portfolio of 3 stocks. International diversification protects against domestic market underperformance. Asset class diversification smooths the ride. Harry Markowitz won the Nobel Prize for this. It's not a fringe idea. The efficient frontier is real, and here's the part that genuinely matters. If you are in the distribution phase, drawing down your portfolio in retirement, volatility is not just uncomfortable, it's dangerous. A 40% drop in year 1 of retirement, combined with withdrawals, can permanently impair a portfolio that would have recovered fine if left alone. In that context, diversification isn't about returns, it's about survival. That argument is correct. I'm not disputing it. But here's what it quietly assumes. It assumes your primary goal is minimizing volatility. It assumes you are in or near the distribution phase. And it assumes that the emotional comfort of a smoother ride is worth the cost in compounded returns over a 25-year accumulation period. For a 31-year-old with $35,000 and 30 years until retirement, none of those assumptions are true. The volatility that diversification protects against is exactly the volatility that, over long time horizons, generates returns. You are not protecting yourself from risk. You are protecting yourself from discomfort. And that protection costs money. There's also a practical problem with wide diversification that nobody talks about. When you own 14 positions, you cannot have deep conviction in any of them. And without conviction, you will not hold through drawdowns. You will rebalance at the wrong time, trim winners too early, and hold losers too long, because cutting them feels like admitting you were wrong to include them. Diversification is supposed to reduce emotional decision-making. In practice, more positions means more decisions, more noise, more opportunities to do the wrong thing at the wrong time. I promised to be honest. Here's the honest part. There are real situations where maximum diversification is exactly right. If you are within 10 years of retirement, sequence of returns risk is real and serious. A 40% drawdown at 58 is categorically different from a 40% drawdown at 32. Reducing volatility through diversification at that stage is not anxiety management, it's math. If you have no edge, no sector knowledge, no information advantage, no genuine conviction about specific opportunities, then owning the whole market through a broad index is the correct concentrated bet. Not 14 positions, 1, the total market. And if your financial situation means that a 40% drawdown would genuinely change your life, force you to sell assets, delay major decisions, create real hardship, then the psychological cost of volatility is a real cost that belongs in your calculation. The problem is not diversification. The problem is using diversification as a substitute for a portfolio thesis. Owning everything because you don't know what you believe is not a strategy. It's indecision with a respectable name. Here's how this story usually goes. Year 1. You open the account with $20,000. You read that diversification is smart. You buy 6 ETFs covering different sectors and geographies. You feel sophisticated. Year 2. You add 3 individual stocks because you have conviction on them. You add a bond fund because volatility is making you nervous. The portfolio is now 9 positions. Year 3. Crypto is running. You add 5% crypto because you don't want to miss it entirely. A colleague mentions REITs. You add a REIT fund. 11 positions. Year 4. The market has a strong year. You check your portfolio. You're up 7% on a year the index returned 24%. You tell yourself the diversification protected you from downside. You don't calculate that there was no significant downside that year. Year 5. You read an article about over-diversification. You recognize your portfolio in it. You decide to simplify. But trimming positions means realizing gains, which means taxes, which means you delay the cleanup. The portfolio stays at 11 positions. Year 6. You're still holding everything. The drag continues. Each individual decision was reasonable. The cumulative result is a portfolio that reliably underperforms the simplest possible alternative. 3 questions. Answer them about your current portfolio before you add one more position. Most people think, am I protected if one position blows up? They add positions to reduce concentration risk. The portfolio grows wider. The right question is, do I have genuine conviction in each position I own, enough to hold it through a 35% drawdown without selling? If the answer is no for any position, that position is not diversification. It's noise. And noise costs money. Most people think, am I missing exposure to a sector or geography? They see a gap and fill it. International, small cap, commodities. The right question is, what is my actual thesis for owning this asset class? And what would have to be true for me to remove it? If you can't answer that question for every position in your portfolio, you don't have a diversified portfolio. You have a collection. Most people think, more positions means less risk. This is true for idiosyncratic risk. It is not true for the risk of long-term underperformance. The right question is, what is the minimum number of positions I need to express my actual investment thesis? And am I holding anything beyond that? Every position beyond that minimum is costing you something. The question is whether what it costs is worth what it protects. 3 things to take with you. Diversification reduces the risk of catastrophe and guarantees the absence of excellence. Both of those things are true at the same time, and only one of them shows up in financial advice. The cost of over-diversification is not a single bad year. It's 1.5% to 3% annual underperformance, compounded over 25 years on every dollar you invested while telling yourself you were being smart. The question is never just, am I diversified? It's, do I have conviction in what I own, a thesis for why I own it, and the discipline to hold it when the thesis is being tested? If this changed how you think about your portfolio, share it with someone who just finished building a 14-position balanced portfolio and doesn't understand why it's not moving. That conversation might save them a decade of quiet underperformance.